Hello, Culture Matters podcast. I'm so excited to introduce you to our guest. Before I do that, here's a quote just for this episode. It's more important to win than be right. Mark Magarian, our guest today, a great friend of the Culture Matters podcast, not only a portfolio manager, someone with 2+ decades of experience in trading, risk arbitrage, wealth management, portfolio creation, but the founder of Magarian Fund. And in the spirit of our beloved Charlie Munger, who once said, it's not supposed to be easy. Anyone who finds it easy is stupid. I had to pick that quote. It's more important to win than be right. Well over $200 million in assets under management, under a strategy that's proven to produce returns for years and years and years, outpacing this age-old S&P 500 or the benchmark, rather, I should say, the benchmarks, I should say. Mark Magarian, thank you so much for coming on the Culture Matters podcast. I can't wait to get inside the mind of a value of the future value investors of the business world. So thanks for coming on the Culture Matters podcast.
Thank you for having me, Jay.
I was so excited preparing earlier because I was thinking, okay, I actually had an advisor at one time, a mutual, or yeah, no, not a mutual friend, but a good friend that actually worked at DLJ, Donaldson, Lovekin, Genret. And I had seen that you actually started your career at that in emerging markets as a trader. I am curious, emerging markets in the trading background, are there nuances or uh, anecdotes that you could say from experience that have been instrumental in the portfolio construction, in your philosophy, in your thesis that has created so much success?
Well, that was a long time ago, and I can tell you that I'm not much like I was then in terms of my process and my behavior in general. I got that job at DLJ, having worked as actually as a board boy at a money broker, and a board boy is basically a guy who before the ages of more detailed technology, they would use pens and they'd write the bids and offers of people looking to borrow and lend
Wow.
money at different timescales on the board, and you just have all these guys from the East End of London who sound like they're from a Lock, Stock and Barrel or Snatch movie, like a Guy Ritchie movie, shouting at you basically to do these things. And everyone's talking in slang like on the dog and bone and all that. And anyway, so I got a job at DOJ because I wrote letters to all the different heads of trading in the city of London. I think I must have sent almost 100 letters, and because I
Wow.
didn't have a degree and I barely finished high school, so I couldn't just go and get a job like this. And there was this book called the Hambros Directory, and you had all the various managing directors, which tend to be the people in charge of these various trading desks. So I sent all these letters out, and I only got two replies. And I remember I had like a tongue infection, a little bit like if you remember the episode of Seinfeld where George gets his fiance to lick all the envelopes and then she dies. I had like some sort of like reaction to all these to all this chemicals I was licking. And
Oh
anyway, I
man.
got two replies. I got one from the Japanese bank. I think it was Mitsubishi. And it was a very short letter. And it basically said, you don't speak Japanese. Sorry. So they were out. And I got one other response. And it wasn't in the form of a letter, it was a phone call. And it was at 9 o'clock at night, which would have been the US close in London, from a guy called Nick Robinson. And he was the head of trading in one of the divisions at DLJ. And he called me. He said he saw my letter, and my letter basically said, "Listen, I'm very interested. I've been doing some of my own trading. I want to. This is what I want my career to be. I've read these books. I'm very fascinated." And he said, "Well, listen, we just hired a junior trader, but his job was kind of like support role to the desk, Why don't you come in, interview for it, and if you get it, well, then your foot's in the door, and you'll no doubt have another opportunity. So I did that, took that, and then when a emerging markets position came up, I snatched that, and that's another story as well. Actually, I can tell you about that
Yeah.
just quick. So
Please, please.
yeah, so that was funny. So I was kind of this assistant role, kind of supporting all these trading desks. So I was eating, drinking with these people. I was there chatting, but I wasn't actually doing the buying and the selling yet. And there was a position which came up on the emerging markets desk, and when I'd heard that they were going to they were doing a trial for a guy from MIT and a guy from Harvard who was going to, for this position. And I went straight to the head of trading, and I said, "This is BS. Okay, I have been here. I'm dialed in. I'm more than capable of doing this job. Getting a degree from wherever makes no difference whatsoever in the application. This is much more psychological and stress management and handling yourself under pressure. Da 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 da." And they said, "Listen, from the top, apparently we have to hire X amount of graduates. There's some excuse." And I said, "Listen, I have, a week's holiday I can use. I'm going to take a week off. So it's free. No one's paying me. And I will sit there on this desk, and you tell me at the end of it who you think the best candidate is." So they were like, "All right, sure, sure. I mean, come in on your holiday." So I did. And the MIT guy it lasted 2 days before he told one of the other people on the desk to go. I won't say what he said, but it wasn't good. And then the Harvard guy started crying. He was lame. He just couldn't handle it. Everyone was shouting at him. This isn't like some cushy college situation. Like, this is being thrown
Yeah.
into the deep end, and emerging markets as well. That was like the Wild West, man. That was like the crypto before crypto,
Wow.
and it was high stress, and I was able to take the stress, and I still screwed up as well when I was in that week. I remember I did a FX trade the wrong way around, but we quickly fixed it and I moved on. But I took the heat, and so I got the job. And it didn't last too long, because then DOJ got bought by Credit Suisse, and I moved to Bear Stearns, and the career
I,
like
I,
began.
this is amazing, amazing story because I want to grab it. If I recall correctly or understand correctly, even DLJ that was a revolutionary thing. They went public at the time. They were doing some like cutting edge stuff.
Mhm.
So I'm curious what that institution saw, and I think it's relevant to clients and people that work with you today, what they could have seen in you that you were representing from a business culture matters, core values, behaviors, like what could they have seen in a because imagine, yeah, so that's why I'm curious. Why would an institution invest in that person, or what core values could you have been exemplifying then in hindsight?
Well, I certainly like to think my list of values are dramatically longer and more robust today than they were then. But the one value I definitely had going for me back then was I was extremely hungry. I worked very hard, and first in, last out. And I wasn't going to let anyone outwork me. And I definitely had a real passion for the business. I had a genuine interest in the world of markets. It was fascinating to me, and that was clear when anyone spoke to me. You can't fake that.
Mm,
So yeah, it was those things those definitely attracted the attention of the senior people who I encountered. They knew I had a lot to learn, but they could tell that I wasn't going to give up, and I could handle getting getting flack well.
mm,
And
yeah.
that's an important skill. I don't know if that's a value, but it's definitely a skill. You need to take a significant amount of heat sometimes in this business, and not crack. So I had that going for me. I still had a lot to learn, but looking back on nearly all of my experience, up until maybe even just 7 or 8 years ago, everything is about how you learn and how you
Mm,
process your different positive and negative experiences. And even though I can look back and I can think of a lot of things that, I was part of or did that were very, were excellent and were definitely a useful experience, a positive experience, something you could, talk about and, try and sound awesome about. But, I don't really see myself through the lens of like, back in band camp 10 years ago, I was the king of the hill. Like I don't perceive myself in that manner at all. I see everything as, I only see the positives through my negatives in many respects, because I look at what I could have done better and what opportunities I had to learn. And, it was really, my career really only turned from being okay to being something else when I learned how to process failure better and process my ideas better. And I think Ray Dalio probably gets most of the credit for that, with his book Principles, which kind of I read in 2016,
Wow.
and that was when something kind of the penny dropped in my mind a little bit as to how to grow more effectively and to manage your own impulses and biases better.
How does processing failure, processing ideas relate to the stewardship of capital, the money management, the wealth creation business
Yeah.
in your point of view?
Yes, absolutely. I mean, when people give you their money to try and make them more money, obviously it's in the business of finance, it's a little bit like doctors and lawyers. Is you don't meet one who doesn't tell you they're the best at it, but they. So
Yeah.
unfortunately, there's a lot of fake it before you make it going on, except for a lot of them don't necessarily make it, or even if they do, that it's a version that is uh, you know, ultimately quite average. And I never ever wanted to be average. I knew what that looked like, and I was never comfortable in it. Um, and that possibly was a negative to me actually earlier on in my career, because I think I was I tried to be beyond what I was capable of at the time. And that leads me to an interesting point I actually made on a call the other day. The guy said it was saying I was smart about something or something like that, and I was like, okay, I don't take those kind of compliments very well. But I said, well, listen, look like this. I am objectively maybe a 7 or 8 out of 10 smart, but I've learned to operate very much at 7 or 8 out of 10. And that's it. I'm not going to go try and be beyond what I really know or understand. But this industry is full of people who are 8 or 9 out of 10 smart, who think they're 10 out of 10 smart. And the
Mm,
moment that you operate beyond a reasonable capacity of what you really, really know, you end up actually operating at 5 out of 10. Like even though you're 8 or 9, and you think you're 8 or 9, but you're operating, you think you're operating at a 10, and it doesn't. No one is a 10. That's God. So
powerful.
it's why seemingly people who maybe who are not rocket scientists like myself can do quite well. I mean, I think Warren Buffett and Munger are probably the OG in this respect.
Yeah.
They come across as sort of, kind of country bumpkins, like to go fishing and, potter about the place, but they're so wise and they know to stay in their lane. And it's a very, it's almost a lost art, really. Um, because people like to talk about it, read the books and all that, but there's not many managers I think who are really, really you know doing it like they did, I guess.
When if we look at, from the DLJs to the Bear Stearns to the Morgan Stanleys to the UBSs, like it's a very, I think, broad breadth of experience. Were there common denominators that you could see? Of I'd love to see ways to muck it up and then where the value is made in that breadth of experience and how that's translated into your performance, in your view.
Yeah, I mean, if I guess I go back to the beginning of the career. So when I was at DLJ, I went to Bear Stearns, and that's when I was a full-time trader there doing all the good stuff. And I started in actually in emerging markets, but then quickly moved to risk arbitrage. So risk arbitrage is essentially the game of, or it also included special situations, which is basically the bit before risk arbitrage, and that's when companies try and buy other companies, right? Or a company is having some sort of corporate action, that could unlock value. It could be a spin-off, a special dividend, or something unusual, and there could be some value to extract between with the market, where the market's trading and that event, or where the offer for a company is and where it's trading currently, or the potential for a counter offer that could be higher. And so, that was my first experience of dealing with very, very smart people at hedge funds. So John Paulson's of Paulson Partners
Oh yeah.
was my biggest client. And I think I may have spoken to John maybe one time, and he probably wouldn't remember me, but I spoke to his head trader thousands of times. And he touched base with him a few years ago, actually. He's still there, even though now it's just really a family office. But anyway, I got to kind of see him early doors before everyone knew kind of who he was. And, this is something the way he operated, which how I do things, but it's certainly, so, I've seen it in some of, Soros's guys like Stanley Druckenmiller. Position sizing is what I'm going to get to, right? It is making the big bet when you have an advantage and it's a very, very good situation. Sizing your bets right is how you often generate significant outperformance. And at the time, for instance, in Paulson's case, he was running primarily a risk arbitrage fund. So, but there was this deal. I remember it was Aventis Sanofi, and I'm sure he'd taken big bets before, and there were probably ones after when I wasn't as interacting with that company as much. But at that time, I think he might have been running $2 or $3 billion. It might have been more, but it was around that. And this Aventis Sanofi deal came up, and he was just absolutely huge in it. And it was a French pharmaceutical company takeover battle, and it was, I think it was Novartis. It was a Swiss company had threatened to get involved, but then the French government got involved anyway. And then there was a higher price paid, and it was this barbarians at the gate kind of situation in the corporate landscape, and it's pretty exciting. And I was trading so much stock in it at the times. I was trading at times. I was trading $1 billion a day
Whoa.
in it, and so which at the time was a lot. And I kind of, this is where from my career on the sell side, I kind of made a niche for myself, which lasted up until until I came to America. And that was when these big risk arbitrage deals hit. I would really, really make a big effort to essentially become the market maker of choice in that opportunity. And the way I was able to do it was, using money from the bank I was working at, I would often take a view on the deal. So that way, I could make prices on it with a little bit more conviction if I didn't necessarily have liquidity to pair my risk off. So anyway, I was big in that deal, and I got to see him, take a really punchy position and then obviously win. And that definitely sowed the seeds of something which I would later learn in more detail, is to, how to take a good position when you're running big money. When the situation is right, you've got to go. You don't take a tiny one. So anyway, yeah, I got to see that, and after I ended up at Deutsche Bank a few years later via a brief stint at Dresdner Bank, and I was doing the same thing again. Handling risk arbitrage. With big clients, and that was my biggest year on the sell side. I made Deutsche a lot of money. I did very well. I met my wife, who was visiting, London to visit a friend. She's from San Antonio, Texas, which is where I am now. And,
I love that.
yeah, she was in a bar. It was actually Hakkasan, so it was a fancy bar, fancy Chinese restaurant. There's one in Vegas now. They're all over the place now, I think. But anyway, it was in Oxford, just off Oxford Street in London, and she's very beautiful, and way way beyond what I would normally expect to interact with. And I saw her, and she was incredible, and I thought I'm just going to stare at her for a while and see if that attracts her attention. Didn't get anywhere, so I was like, okay, looking a little stalkery, better go and say hello. And so I went in with the no game, is how I like to call it. So, back in London, there's footballers, soccer players, there's, Arab and Russian oil billionaires everywhere. Like, no, you're small fry. And if there's beautiful women in London, you're not, you're up against it unless you're doing really well. And I wasn't doing that great. I was doing all right. But anyway, so I went in with a no game, zero gain whatsoever. Don't try and show off about anything. So I just went and said, "Hey, you're beautiful. I heard you laughing. You sound really fun. I just want to introduce myself. Have a great night. I'll go now." And anyway, she went for it, and
Wow.
we dated back and forth and ended up getting married in a castle in Scotland. She lived with me in London for a few years and then moved me back to Texas. But the move back to Texas was a twofold situation. So, like I said, I was working for Deutsche Bank. I was having my best year of my career to this point. But then '08 showed up. And so it didn't matter how well you're doing, no one's getting paid. So they basically said, okay, who wants to get let go and get a golden parachute, And I was like, yeah, I'm gonna move to Texas because I'd already been spending time in America, and I was like, oh my goodness, this is the land of the free, land of opportunity. I was living in a 700 square foot apartment in Chelsea, which was, 1.5 million back then. It's probably tripled that now. And for that price, I could buy, two 5,000 square foot homes in a private gated community where all the basketball players lived in San Antonio. So I was like, this is, I couldn't imagine in my wildest dreams to live in such a beautiful place. And so I was like, this is where I've got to go. So I moved to America, and um, I guess I can, skip through some of the other places I worked for. I basically became a financial advisor. And initially, I, just raised money from, modestly wealthy folks to manage. And I didn't really have a strategy per se. I had my resume. It was like, I've worked in London, I've worked with these people. I sound like I know what I'm talking about. And in truth, it was like the example of the doctors, the lawyers,
Yes, yes.
I was definitely overstating my knowledge base, but I didn't really know it at the time. I felt like I knew what I was talking about, but I looked back on it and I was like, "You didn't know what you were talking about, dude." But that's a measure of growth. I mean, I really wasn't attempting to be, false or anything. I mean, I believed in myself. I always have, but I didn't have the execution down. So part of the issue, why my performance initially working with people back then wasn't, it was market at best, was uh, I couldn't really figure out what I was. Was I a trader? Was I a long-term investor? Like what was my goal? And it was in 2015 where I started to think like an investor. I remember I'd invested in a lot of gold mining companies at the time, and it hadn't gone very well. They'd gone down, and I did what most people do, is they think they know about the stock they own, but they don't. They have some peripheral data point or some soundbite information about it. They've done this. Wow, must be a good investment. And of course, that's not enough. How do you know? You could say they'd discovered the cure for cancer, but if it's trading at $10 trillion, maybe it's priced in. I mean, you know what I mean?
Yes,
So,
yes.
so it's much more about the value. And it was during that time where honestly I was down a decent chunk that year. And that's obviously not the strategy I operate today. It was, people's accounts were very different. It wasn't like managers of fund. I started to look into, companies in much more detail. I was like, okay, like I need to know more about what this is. Otherwise, I don't have the conviction to hang on. And so I really started looking in great detail, and, I was able to position myself for 2016 to be a very good year. Like that was, a very good year. But even so, that wasn't, as I said, that was really the infancy of the thinking of what I ended up becoming in terms of a strategy today. But it was then that I read that book on Ray, from Ray Dalio. My children showed up in 2017. All these things contributed to me wanting to sort of reboot my mind in a manner that was going to create a much better growth trajectory for me. And um, yeah, I just started looking at businesses from a very different perspective, and which became my process today. So.
I'm very
I
curious
can
what you
go into
think
it.
of
I want to stop for a second, and let you speak.
von Mises. Well, this plays into all of it, right? Because Ludwig von Mises said education rears imitators, but the economy needs people who can think.
Yeah.
So what's your take on thinking and the process and the role, or yeah, the goal and the role of process in the performance that the data has shown you have such great success for your clients.
Right. Well, as I've alluded to, I've made many mistakes, right? I don't think anyone starts out in this business, perfect. What's that old saying? You're both it's the idea of this marble sculpture, but you are both the sculptor and the marble.
Mm,
In other words, it
yes, yes.
hurts to carve yourself into what you want to be. And, wisdom is something which is acquired. And so, yes, the process um, that exists today is really founded on the principle that, take every company that you look at and forget about P ratios, forget about traditional valuation metrics, or I guess commonplace ones like earnings per share and stuff like that, and look at it as if you were LBOing that company. You're taking it private. Look at every company through the lens of balance sheet statement, cash flow statement. If this was your company today, how much money would be landing in your bank account and to go out and spend and have a good time and enjoy yourself. And
Mm.
you know, once and look at it from that perspective, and from that point also look at what it would look like in a few years' time. So you've kind of got to, that the company you're buying is 18 to 24 months, which is Druckenmiller said some similar things to that extent. So I'm not going to pretend I invented that, but that's definitely where I came to naturally. And so when you're looking at it from that perspective and crafting that view of it in a few years, you have to look at it from that perspective. You've got to look at it um, from you've got to understand what management's thinking. You've got to speak to management, understand, what their views of the company are, and get that nuance from them that not isn't necessarily written down. So it's information it's not public. It's just lesser known. It's the kind of things you get in the earnings call transcripts when they answer questions, about what their plans might be. And it's when they say maybe we'll do this versus a hard no, or maybe we'll do that. You start to get an idea for where management might be in terms of their thinking for the future. So, yeah, you're looking at it like it's a private business. You're speaking to management. You're establishing what nuances there might be in their actions with use of capital. And
Mm.
if that image of this business you're looking at with an appropriate multiple for whatever this type of business is, because it's a little different for every industry, if that looks like it's crazy cheap, really cheap, then I'm
Mm.
interested. And so by definition, I typically don't buy companies that aren't already somewhat in the dumpster and haven't had some sort of downturn. And so, yeah, that is it in a nutshell. So real world businesses that are disliked, and you know, if you can pick them up for crazy cheap, then it's definitely on the menu.
I just want to go back to something earlier. I want to clarify. Uh, the Paulson gentleman you referenced, was
Mm.
that the gentleman that had a massive return in the recession? There was a book I read or something like where
Yeah, he was the
he
one
had
who
a
bet
check in his
on.
office, like $1 billion or something.
Oh yeah, ridiculous. Yes. Yeah,
I wanted to ask that because I think his brother was like the Goldman guy and ended up like as a higher the Paulson. There's a book he wrote books. He
Yeah.
had a brother. Is that who I'm thinking about? I wanted to
Yeah,
ask you
no,
that
he's
earlier.
he's 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 of some legend now after the '08 stuff. But I had no interaction with their company on any of those things. I didn't even know when I was still dealing with him in '07 before I left that he was that was a trade he'd even placed, because I was
Wow,
I
wow,
was
wow.
purely risk arbitrage. So I would see some of the interest there. And but yeah, no, incredible. I'd like to, we'd like to think that if we could see an opportunity that good, we could bet that big. But that's another example of when you think that you've got it right. That's how you go after it. And even though they made a movie about The Big Short, Michael J. Burry,
Yes, yeah.
Paulson was the much better example probably of the trade in terms of timing and scope. So, but anyway, yeah, just yeah, another checkpoint that
Mm.
was
Wow.
that guy was obviously amongst the legends these days.
So private looking at the organization like you're actually would own it yourself.
Mm.
That's foundational to you. And
Yeah.
yeah, so can you elaborate on that a bit more?
Yeah, absolutely. So, when you're looking at a private business, it has to meet certain valuation metrics, obviously. And I said it has to be crazy cheap. Well, let me define that further. So, if you buy Apple today, right, it's a great company. It's not really growing very much anymore, but it's obviously a ubiquitous company. It's the valuation right now is the equivalent of investing $1 million to make maybe about 25 grand a year after tax, which isn't very good.
Wow.
And in the real world, I'm not sure you would do it. Like, because it's liquid, people have a different perspective because you can buy and sell these stocks, you can trade them. But if you take the perspective that it's not liquid, then cash flow suddenly counts. Like, if you had to lock up your money with Apple for 5 years to make 25 grand a year, I don't think anyone would own Apple at all.
Yeah, isn't that 2.5%? That's 2.5% return.
Right. It's no good. It's not worth it. So when you have the perspective of that private acquisition, you're not thinking about it as if you could sell it to the greater fool next week. You're assuming that you're somehow locked into this thing for some amount of time, in which case that return of capital through cash flow is the most important thing. So as some examples, on average, I mean, it's always a little different, but I look at a situation where if I invest $1 million, I could make 200,000 or 300,000 a year. So a 20 or 30% free cash flow yield. If it's less than 20, like it's in the teens, then it would have to be either something that has got some high growth potential, or it's truly in the world of monopoly level business. Um, so, yes, I will look at those, but for the most part, most of the things I like to touch are usually 20 to 30%. And sometimes when it gets really ridiculous in a certain sector, like oil, for instance, in 2020 during COVID, when it went negative, that sector got destroyed. I bought a natural gas pipeline company with a 40% free cash flow yield. 40%. That's $1 million to get paid 400 grand a year for something transporting gas to A to B in a part of the country that if it stopped gas pumping, then most people would, it'd be like mass deaths
Mm.
during the winter. So, and in that example, actually, the gas didn't even stop flowing due to COVID. Like, it was nothing really changed. So, when there's, great panic in an area or sector, and then potentially also the market as well, like that, you have that layering effect that I like to look for. It's kind of like that movie. I use the example of the movie Inception, the dream within a dream.
Yeah. Yeah. Yeah.
So, if the sector's down, but then the market's down too, and then maybe they cut the dividend, there's something else that you have this series of layers happening to a stock. And if you have enough happening at the same time, then that discount to intrinsic value can get quite substantial. And that's what I'm trying to do. I'm trying to buy a dollar, something, that's worth $1 for 30 or 30 cents, 50 cents maybe at most. I won't buy it if I don't think it will double within 2 years. That's another general rule. Um, and finding situations which do have that layers of hate and circumstance, as long as you can have a very credible, high confidence view that that company, if in at least in a couple of years, 18 to 24 months, is going to fit that criteria with a reasonable degree of of confidence, like I said, then that's the setup. That's what you're looking for. So, it doesn't usually come unless there isn't some degree of fear and hate or misunderstanding, at least,
Mm.
to create that opportunity. And that's what I spend a lot of time doing, obviously, is finding those opportunities. And when I do, I'm much more concentrated about it. I don't own 30 or 40 stocks. I don't even own 20. I have maybe 13 right now, 14. So it's much more concentrated, and that's kind of part of the source. I want I force myself to be more concentrated. I want to have the very best opportunities, not just a blend of a lot of average ideas. I don't want to diversify for the sake of diversification. My strategy generates significant alpha on the market and has done, and that's part of the reason for it. It won't do it if I don't do that. And the negative you take on that is sometimes it can be a little volatile. But to me, volatility is a psychological event, especially if it affects you negatively. It's not necessarily the volatility of the balance sheet. Like if this was a private company again, is the balance sheet really changing just because the
Mm.
market's having a hiccup? Probably not.
I
And
want to ask in
so,
that sense
yeah.
from a client, so client meaning those that want to grow their capital with capital, they want to grow their wealth that are listening to this. How would you suggest they should view participating in these types of vehicles? Like what core values help them relate or respond to the psychological aspect to ups and downs of business, ups
Yeah,
and
I
downs
mean,
of investment?
yeah, I mean,
How should I be looking at this if I
right.
were that person saying, you know what, I like this guy. He's uh he's smart, but he's also humble. How do I need to show up best as a participant in your view?
Well, I mean, it depends if you're specifically looking to invest with me, let's say, or if you're just looking for someone to help them with their investments in general. And I think I'll talk about it from that perspective in general. Obviously, everyone has a different risk tolerance. I think that again is mostly psychology. If you're, for instance, if you have $50 million, but you're 80, you shouldn't be investing like an 80-year-old because the money is multi-generational at that point. So it's a different, it can't just be age-based, and then also your tolerance, regardless of what people think your tolerance is, and that there is there's an important factor. However, one should force yourself to be rational about what is your long-term objective, even if you didn't think that you didn't like seeing some movement in your portfolio because of your whatever your self-perception of risk tolerance is. If you're educated properly by your advisor or your fund manager, then it should be whatever that part of your strategy is, it should be appropriately sized, but also you should understand what it's doing, and that when it does drop, it's not because it's time to panic. It's just simply panic broadly that isn't necessarily a reflection of the assets that you own. And so speaking for myself, I've had, I don't have a lot of panickers these days because everyone's pretty well trained in understanding that when the market does have a hiccup, and no doubt, if a lot of that stocks that I own usually go down, um, it's it's an opportunity. I've made my biggest and best plays whenever the market's had a hiccup, whether it's been a small one or a big one. And as long as we're sticking to the process, as I've alluded to, then the balance sheets are strong, the cash flows are good, and the valuations that we're buying at are extremely good. So, you know, that portends to not only a longer term downside protection. But what has often happened is it means that when there's some sort of comeback or good times return, your upside is considerably higher than the market. And that's kind of part of the strategy. So,
I want your thoughts on like this metaphor I've been thinking about quite a bit. So we have a target, so a bow and arrow. You have your target. You need the arrow. You need the bow. If you don't pull the bow back, you could have the target. You could have the bow. You could even have the best arrow, sharp. But you got to pull the. You need the tension. So like I look at the tension as the inevitable ups and downs of life, business, investing, whatever. I'm curious what your thoughts are on that. Like the you need to have the tension, or we need the it to be taught TAUGHD.
mm. Yeah, no, I see where you're coming from on that one. Yes, I think that there is always that tension, and you should expect it. And whether I own private businesses as well, obviously, and the real world has sometimes some different factors. Even though I look at my strategy as if it's a real world acquisition, it's the market psychology that comes from, I guess, the drawing and the releasing of the bow, in your analogy, that creates some of the best opportunities. You just have to remain rational, and you have to really know what you own. You have to know.
Mm.
And I go into some quite significant detail to make sure that I do. And when I feel that there's an opportunity through the process that is standing out more than the others in that asymmetric, lens, then that is usually the holding that ends up becoming my biggest position. You know, for instance, Warner Brothers, right? I think was my largest holding. Buying it in the sevens with a 30%, almost a 30% free cash flow yield. For a company that owns the IP of Batman, Superman, and Game of Thrones, and if you'd spoken to management and read the transcripts, you could have already ascertained that the splitting the business was already on the cards. You could have ascertained that losing the NBA to Amazon was actually a cash flow positive event, not necessarily a negative. You could have gotten so much information. Well, could have. Well, we did. I'm saying from
Wow.
someone else because the stock was in the dumpster and people were scratching their head. It's like, well, what was it doing down there? Why didn't anyone else buy it? Well, that's the funny thing. When something gets really hated, and it was hated for good reason, but it had gotten too much and the tide had turned. And then, sometimes situations play out sooner than expected, and now it's doing, it's up a lot because, there's a potential takeover on the table. But
There's an
even
interesting
if
irony
that,
there.
yeah,
Sorry, no, go ahead. Sorry, I got
I was going to say,
excited.
even if the takeover doesn't happen, there's still some big catalysts out there down the line, and it looks like a good one. So, yeah, very happy with it. And, there's been other winners this year, but that's definitely the biggest one so far.
The irony came to me in this way. America, we were the underdog story,
Mm.
but what you're talking about an underdog situation where maybe the crowd was looking at the underdog and not doing anything, not really getting behind the underdog, but the outlier that has done the work, done the research, sees an underdog where others just see they don't see anything. I just think it's interesting. America is the underdog society, but yet we miss opportunities every day that are right underneath our noses. So I want to dig deep into because you've mentioned knowledge and understanding quite a bit. So um, to you, what does it mean to know or to understand? And like how because this show often we talk about the importance of reading, writing, speaking, listening. Um, who do you in your due diligence when you're what are you reading? Do you have a writing process? Who are you speaking to? Like to get to the know, to go to the without divulging too much of the methodology, I guess, but whatever you're comfortable with. I'm curious from that perspective, from a practitioner, professional, master standpoint, right? How do we get to mastery?
Well, I mean, I probably have some books I would certainly recommend, and I still reread them today, especially in audio form when I'm on a long drive or something like that. And Howard Marks is the most important
Oh
thing.
yeah.
uh,
Yes.
and also Mastering the Market Cycle by him. I mentioned Ray Dalio's Principles already. Benjamin Graham, The Intelligent Investor, Poor Charlie's Almanac. Those are probably some of the best ones right there if you want to become a value investor. And I probably will never write a book on investing if it's ever proposed to me, not simply because I'm not very good at writing, but also because these guys did so much a better job that there's really no point. I just, my book will be a small pamphlet. It'll be like, just read this guy, and this guy. Good luck. You know,
Well, hey, Plato wrote before Socrates, so there you go. You have
there you go. Right.
yeah.
So, but I do like to revisit some of these important you know, educational pieces to hear if I'm hearing anything different or if or how I've applied some of the knowledge that I've acquired, which maybe have been influenced by something I heard or read. And so that is a good practice, and those books are definitely a good place to start. In my day-to-day job, though, part of my process is to really externalize different ideas, get them out there, keep them short, kind of like I just did with Warner Brothers. Keep it in under a minute or two. How do I tell an idea that sounds ludicrously cheap and good in a short space of time with catalysts and with credibility? So, spitting that out to different types of people is definitely part of my process. Now, Pine Valley, the investment manager who and the RIA, who I also work for, has an abundance of smart people to talk to. Many of them personally. And, those guys are a great place to start. But I've also got different clients who've been with me a very, very long time, who I externalize to regularly. And then also even talking to, folks, whether it be, my wife or other friends who aren't necessarily, so market savvy. It's actually an interesting exercise being able to break an idea down into something that just someone who's not in the business will understand. So I'm not using maybe such fancy terminology. I'm trying to keep it super simple, and that also tend to be a good marker. And honestly, most of the time, I always get some good feedback. I do, but most of the time, I just have to hear how I sound. I need to hear how I sound. By the time I finish saying it, I usually end up thinking that I don't own enough of this thing, or I think this is a stupid idea. And so,
I love that.
and I usually can tell when I'm onto a good one, where I just start like, I'm at night, I'm like, I'm like, can't sleep. I can't, I just, I know having spoken about it to different people that it's sounding ludicrous, and I don't want to be too cute, in terms of getting into a position. Sometimes, stocks take a year or two to base. Sometimes they take a few months. You
Mm,
just don't know, and it's difficult to time that. But if there's a truly, an opportunity that fits my, asymmetric criteria, and fits all, ticks all these important boxes, then it's not rational for me to not be long. And if it's really, really good, in my mind, it's not rational to be really long. So,
yes.
you've got to get in there if it's right. And, I'm always doing a lot of experiments with the portfolio to ask myself interesting psychological questions as to gather which ones are the true winners. So there's a lot of different techniques. So Buffett had the punch card,
Oh yeah.
so
Yeah,
20
but if you want to explain
punches.
it, yeah.
Yeah, well, he had the idea that if every opportunity should be looked through the lens that you only have 20 shots in your entire life. Like, would this be one of the 20 you would take? And it's a good mentality because it will steer you away from the average stuff. As I alluded to earlier, I don't want a lot of positions. I want the best ones, and so there's a little bit of an overlap there. But I have my own ones. Like I have my get on a boat um, trade, and I actually got that from I have a childhood friend whose father used to own a commodities trading company in the 70s. And, I was maybe a young teenager at the time, and I told this gentleman that I wanted to become a trader, and he was like, "Oh, very good. Mark, I have I have a funny story to tell you. You should always tell stories." This guy had a real posh accent. I don't know if I'm doing it right, but and he was like, I had this guy. He was our best guy. He made more money than anyone else. And what he would do is he would look at some charts, make some calls, put on some trades, and then get on a boat. And we wouldn't hear from him for sometimes 6, 9 months. And then he would come back and he'd have more money than anyone because the way he figured it was that, if he'd come up with a good idea, he didn't want to look at it. He didn't want to mess with it. Because people do mess with their ideas. Once they're out there, they sell too early, they chicken out, they choke. He had like, this is it. Here's my stop loss or whatever. Here's my target. I'm just gonna go. And this guy made a fortune. And so I don't even know what this person's name was. He might be someone well known, but either way, my get on a boat is this idea that if I will I get on a boat for a year or maybe even two, at least a year on a stock. So that immediately removes a bias from me, as in, am I a trader? Am I trading this? Is this just a short-term thing? Like I think it could spike up, but it might just come all the way back down and go down. In which case, you wouldn't hold it for a year if you couldn't trade it. Is it something where you'd be comfortable that it wouldn't have any financial difficulties, or is it bankruptcy risk, or it really puts you into that long-term mindset.
Mm,
So yeah, I asked if I could get on a boat. I have
love that.
I have some others as well. I try and challenge myself that if I could only have 5 positions, sometimes even 3, if I could just have 3 and no one else, and get on a boat, which ones would it be?
Oh, I love that.
And so that again. forces you, and it's difficult. You know, it's a lot harder than you think sometimes. You know, usually come up with the first one straight away, and that means that that's the one you need to have the biggest position in. But then the second, the third, fourth, or fifth, it can be a little bit of Game of Thrones going on to decide, you know, who is the winner. But it's a good exercise to find out the ones you really should be focusing on. Even though I have more positions than that, but you want to see where the best ones are. And of course, the best ones are relative to price. You know, there could be one which doesn't make the top five, but it drops so much that now it's the top one or two. You know, it depends on how much value there is and where the opportunity is. So it's a constantly moving target. And I'm always doing it. I'm always having to sift through the whole thing to see where we are in
What's your take on passion and the role that it plays? And
passion. Passion, yeah. Oh my goodness, yeah. I mean, that is the that, and you know that which is kind of married to that focus thing. I remember when I was a kid, I came up with this idea of having insane focus. You know, but it was my idea that basically saying that I could, if I just focus on something like
yeah.
crazy. This is like someone who's ADHD, right? Like, you know, I'm gonna really focus on something.
I'm laughing because it's our fifth core value. I'm like,
Oh,
that's
it is.
funny.
There you go.
Yeah,
Well,
yeah,
that's
yeah.
probably been written
It's
somewhere. I
good,
just don't
but
remember.
hyper focus. But
Oh, is it
sorry,
called
go ahead.
hyperfocus? Right. Well, there
No,
you go.
what I'm taking what you're saying. You're like, yeah,
Yeah, no,
yeah,
exactly. You've got to put
yeah.
yourself, it's kind of, it ties into the 10,000 hour thing as well. It's this idea that if you really, really, really push on something for hard enough and long enough and you're focused enough on it, that you know you can get an advantage on even the smartest people who aren't as focused as you, aren't trying as hard. So that is certainly an important part. And to me, that is part of the passion, because I don't think anyone can do that unless you have a passion for it. It's
Mm,
somewhat of an overlap, I think. I mean, maybe
mm.
the passion bit is ties into more of an emotional idea that you enjoy it. And I enjoy what I do. I mean, I'm going to be doing this till I die. I will never stop doing this. This is my life's work, and you know, I very much enjoy it. I don't ever envisage a time where I will stop. You know, I'll stop like Buffett, like when I'm 90 something, if I live that long, and I'm about starting to forget where I left my toothbrush, you know, or
I love that.
something
Hey,
like that.
Yeah, Charlie was 99 and 11 months. I think it was November 28th when he
Wow.
lost 2023. I believe. Yeah, it's a rough. So that makes me happy because you got a long, long road. I did want to ask about because you mentioned Pine Valley Investments. We've had Michael Modica on the show, Noah Modica, Nick Lampone, some other mutual friends, supporters, clients. Um,
Okay.
I'm curious about the core from a core value standpoint. Where have you seen complementarity in this relationship, or this
Yeah.
collaboration? This
Certainly, certainly. You know, the team, because you know the Magarian Fund has my name on it, and I didn't want to call it my name, by the way. They insisted. I wanted to come up with some, you know, like everyone else does, like Aegis Fund, or like, you know, what's another word for shield in Swahili? You know, you know, which is, but thing is they're all taken. They're all taken. I tell you
yeah,
what the problem is if it's like a good one, they'll sue you for using their name. And if it's like a bad one, you don't want people to Google your name and the bad one comes up.
yeah,
So
yeah.
basically, unless you just literally make up an entirely new word, then anyway, but they wanted to call it after me, I guess, because my name is somewhat less common, so it's an Armenian name. And so they decided that that was going to be it. So I was like, all right, I'm going to argue about other things. But yeah, you know, it's a team effort. You know, it's certainly my IP, and it's I'm the main man when it comes to running the investment portfolio. But you know, there's a lot of infrastructure as well. There's good collaboration. In in terms of idea sharing and running it through that mill, as I'd alluded to earlier. But also, you know, there's a lot of administration. There's there's a lot of other cogs to make sure that the whole thing works properly. And you know, Pine Valley is is a very trusted organization with many billions under management. A lot of trust, a lot of infrastructure, not just physical, but also compliance and oversight and everything else like that. That the Magarian Fund gets to to essentially synergistically interact with and take advantage of to have to build a more robust product from the outset, so that I'm focusing on the investments, and there's not all these other things which aren't being done properly, which need to be done right. So Pine Valley has a lot of, is a great company, and they, we're great partners, and it's good to work with them. But the people, yeah, from a values perspective, yeah, these are honest people, hardworking people. They are, they're all different. They all have their, different passion focuses in terms of the market and in finance in general. So we're all kind of in the same club in that regard. But yeah, there's a lot of great people there, which is, it's an honor to partner with them, because finding good people who you can trust, who also trust you back, is it's hard to do sometimes. It's I
Mm.
think it was easy to find people who you can trust at that level, and it's life is not always that simple. So to have that is a good thing. And our relationship has built over the years, and a lot of the folks there invest with me personally, so there's that sort of proof of work trust, which is quite rare to do that, and is a great honor, may I add. That is very, not a lot of people in finance let other people do it. They like to do it themselves. So to
Mm.
make that move is a real it's a big compliment indeed. But yeah, I think that it's a great team, and I suspect we're going to be hanging out together for some time. We all get on,
I
we all get on very well, so it's easy peasy.
I am curious about, because we haven't addressed it. There are many of our listeners that are, they listen to the audiobooks, they get the Instagram uh, videos and their feeds, pushing, influencing towards, because you mentioned some people do it themselves, do it themselves, do it themselves. What's your take on some of the sacred cows that you would want to challenge on personal finance, or, not giving financial advice, but more of your take on, you know, be yeah, beating the benchmark, and what that even means? Because I've read a lot of books that say that that's not possible. You're not real, and this is you're a fish, catfish or something. You're an
Yeah.
AI bot I'm talking to right now. This can't be real. This can't be happening.
Yeah, well, if you believe that, then unfortunately you might be an NPC, because it's not true. What is true is that most people don't, and that's understandable. So if most people don't, then the safest bit might be to not try. But it doesn't mean that they're not out there. I think the trick is to identify that, and what you're looking for is really a 5-year minimum track record, and a process that sounds credible and repeatable. And that, if you put it through that lens, you'll find that the amount of fund managers out there that are worthy of consideration, gets quite small. And so, there's other factors to consider as well, because your question kind of touched on a few things. And a lot of people trade a lot more aggressively, invest a lot more aggressively with their own money than I would ever invest, even though some people would consider me to be quite aggressive, right? Even though I don't see myself that way because of how I look at the world. But having fewer stocks, some people would call that aggressive, right? Um, but I've met a lot of people who have great investment performance personally, but they're a lot more aggressive, take considerable risk, and how much of that is luck or repeatable? Don't know. But I do see that. I do think that depending on the amount of money you have to start to think about, you know, even if you do a lot yourself, diversifying your mindset, thinking about it from the perspective that if you got hit by a bus tomorrow and your kids and wife aren't necessarily so engaged or understand how to manage these things, wouldn't you want a couple of managers on board who even if they don't do things exactly like you, but they perform well, they're going to be a good place to start to help to continue to steward your money in your after you're gone. So there are other factors I think to think about when when you're considering hiring someone like me. It depends on how it fits into your, your picture. But I mean, a general rule we've been using is, if you're a qualified participant, so that means you're QP, as it's called, so you have 5 million net worth or more, then if you have, for whatever reason, have the tolerance for equity market based equity investments, then whatever you would have in that 10 to 20% could happily live in this, is generally what the way we do it. And I think that's fair. Now, of course, with me, it's everything's in it, because I'm going to drink, well, I'm going to, drink my own Kool-Aid on that one. I'm not gonna do anything else. But for other people, especially when you're managing large amounts of money, yeah, having a few different managers, where you can spread your ideas and spread the pot, is a good thing. And I think apart from the performance, obviously, and maybe some of the ideas and the process, that is a compelling part of what we're trying to get out there. One of the biggest things that really differentiates us in the last 5 years, even with excellent performance, we've not owned one Mag 7 stock once. I haven't owned Nvidia, Apple, Microsoft, Google, Facebook. Although I should have bought Facebook in 2022, I messed up on that one. I almost bought it, should have done it. I'll tell you about that in a second. But regardless, though, is we still generated great performance without owning those companies. And so, when you're thinking about people who want to index, as you alluded to, well, indexing is really just being long all that these days. The concentration's so high. And then if you look at most managers out there, I mean, I'd say that's probably a fair statement. I mean, a significant amount of long only equity managers, if you look at it, they all own this stuff. And so what are you really getting, which is different? You probably, at least I can say that I'm not investing in any of that stuff, and I'm still generating returns. So that's probably a good place to start when you're thinking about true intellectual diversification and how that might tie in while still wanting to do better, right?
I want to share a personal opinion of mine, more of a
Yeah.
theory, okay? And you can choose to share it or not, or go to the Facebook thing. It's at some point, if there's any type of, whether it's a black swan, let's just say an inevitable downturn, if so much of the capital is indexed, couldn't that create a renaissance opportunity for individual security picker, individual security investors? Like, as if all of the lay people that have so much of their resources in these indexes naturally respond, because naturally we all would buy high and sell low absent help, then I would think things to become, it's almost like the seas are, parted, or Charlie Munger says, if we see who's swimming naked when the shore goes out. So if the shore goes out, somebody like you, and we've had some others on the show, jump in and we're like, oh my God, there's gold here, there's gold here, there's gold here. So I've had this opinion that, at some point when things, some type of maybe you could advise me on this, not an event necessarily, but like you were at Deutsche Bank in 09, 08, when that was obviously an event. How did that infect the culture? Who became extremely wealthy then? I think we talked about one person, but I would love your feedback on that. And we've explored it a little on the show because we've had value investors on the show, so it's not super out of right field. But yeah,
Yeah.
what do you think? I think there's a renaissance coming for
Yeah.
investors like yourself.
I think there probably is, but I would actually argue it's already here. I think
Oh, please, yeah.
my performance says that it is, and I think that because most people, are befuddled, should we say? I want to say it nicely, by it, and I guess that's a unusual compliment, but it's hard to talk about this stuff yourself without sounding overly confident. But I can tell you, my day-to-day life is one of being very humble about everything that I'm doing, and certainly being self-aware of my capacity to make mistakes. But that doesn't mean that I'm not able to stand by my work and stand by our numbers and say, yeah, this is good. So I think it's already here. I think that indexing and the way that capital flows and how different managers are being forced almost to buy these large cap tech stocks to try and keep up performance. It has created, I tell you what I think it's
Interesting.
done, because I think what you're alluding to is maybe an upsides rotation, which may come, but I think that the troughs in valuation to some of the areas that I'm in have become more profound maybe than usual, because
Ah,
capital flows operate now is once you're getting thrown out of an index and you're not in some fancy fad area, people just dump you and you just get left to dead. And that may well be why I'm seeing more opportunities maybe than usual. Now, in 2022, we were up, decent double digits that year, and the stock market was down about 20%, right? And it was down a little more at one point. And so that year, the water did come out, the tide did come out in tech stocks, right? But then other areas did very, very well. So,
mm,
cheap stocks can do well in bad times. Just depends on what kind of bad time. That was more of a tech sort of mini bubble sort of imploding after the COVID run up, right? But '08 was more of a systemic event. I would for sure take big downside then, but I'd probably be up multiples of the market the next year. So in that scenario, it's all about survival. '01 to '03 was more of a rotational bear market as well, outside of the September 11th moment. So there are different markets. It's always a little different, and I'm always looking at history. I look back all the way back to the 1920s quite often to look for analogous situations that might tell me what kind of version of the world we're in. And this is something Ray Dalio's done a lot on, actually. And he released a book on cycles recently that kind of touches on this. And, I always used to thought like this, and I'm glad that someone smarter than me has put pen to paper to give more of an educational detail on it. But yeah, I'm always looking at it through the lens of cycles in general, actually, but also that these cycles often rhyme. They may not be
mm.
exactly the same, but they sometimes rhyme. So yeah, I think we are entering that, and right now we're probably entering an area where more economically cyclical companies are, really doing poorly, and there might be an opportunity there coming soon to take the other side of that. So we'll see.
I, I I know you're a well, clearly a student and clearly a peer now. Howard Marks, he's got some amazing books you mentioned before. I know you're a student of Howard, and you might not accept this, but I do want to acknowledge I was listening to a podcast before we did this, a podcast you were on to prepare, and we could talk about this a little. You were talking about gold and where it would be, and had to look it up, and it was mentioned that it could go up 50%, and right now as we record this, it has, and I was excited about that. Now Howard Marks would say he's predicted 11 of the last three recessions. So I
Mhm.
where I'm going with this is, how do you so good job on that. That was exciting. Um, how do you balance macro with micro in your
Mhm.
case? Uh, uh, Being a student of history, a user of metaphor and analogy, as well as being a math guy and a numbers, a probability, and someone that understands calls and puts and how to react to or temper risk. I want to go in that direction as we
Okay.
start to close.
Well, let me mention on I guess the macro components. That's a good one because I'm often quoting people and myself on the macro side of things quite often, and it's this idea that um, everyone has a macro view. You turn on TV and there's someone with a macro view, and he sounds super smart or she sounds super smart, and it's they're ten a penny. And as Howard Marks alluded to in your quote about predicting 11 of the last three recessions, is that everyone's always predicting something nonstop, and it all sounds very credible. And what's even more ridiculous is everyone is almost right, but not at the right time.
Mm,
Okay, you can predict there's going to be a recession, but if it's 3 years out, it's worth less than a free cup of coffee at Starbucks. Okay, in fact, it's a negative because what's going to happen is you're going to miss everything in between being too cautious. And so it's very, very hard to predict the future. Sometimes the crystal ball gets clear, like if it looks like an event is manifesting in a certain way. I find it's easier to predict things when there's panic because panic usually overshoots in one direction, and there's only so far and so terrible things can get typically. Not everything goes to zero, and trees don't grow to the sky. That's a Howard Marks thing as well. But
I love that.
so I think that, with me, I'm always trying to temper my macro view because it's usually wrong or early. And so, when I'm making an investment, I try and take a macro assumption into account. But I like it to be more of an embedded bonus, if it works out. So even if it doesn't happen, I'm going to win. Like if you buy something just because you think macro component is going to work out, the economy is going to improve, the oil price is going to go up. Like, if it doesn't happen, then how much money are you going to lose? I want a situation where, um, I'm buying something cheap enough that even if it doesn't happen, I should still win something. And then if it does eventually happen, then I'll win a lot more. Um, so I like to make the macro component a little bit more secondary. Otherwise, I'm now dealing in, magic and things that only God knows. And so you've got to be careful with that. I mean, don't let the macro get in the way of buying a cheap stock, is what I like to say. And that's because if something is really, really cheap, you know, you might miss buying it because you're waiting for some macro thing which never shows up, and then you'll be kicking yourself. So,
Mm,
if it gets cheaper and it's truly that good an opportunity because of the macro, then buy more. Save something to buy some more. And that's what usually happens if that's the way it pans out. Now, you also mentioned options. Yeah, we use options in the portfolio as a form of hedging at times, some de-risking. It's not a huge part of the strategy, but it's there. It can be used to create some mild upside gearing if there's an opportunity that is best expressed through options. So it's just another tool. We've got Harry Morad, who's the one of the partners of the fund and one of the founders and partners of Pine Valley. Has an extensive options background, and he's always good to chime in on ideas on that. But we've got a lot of people, Mike Modica, who you mentioned earlier, he's pretty smart with options too. So we've got lots of guys on the team who can kind of help with that as well as my own interpretation. And it's really just about adjusting risk in different ways. Can something be expressed through the options market in a more efficient manner than in the equity market in the underlying? So it's there to tweak and to hedge essentially. And
mm.
it's a good tool to have, especially when things get, tricky in the market. Sometimes, there are disconnects that are more vivid in the options market than even in the equity market. So it's good to have that ability to take advantage there within the framework of the process I've described. This isn't an options trading strategy. This is a buying cheap stock strategy, which happens to use options for hedging or for, more enhanced position entry, should we say?
Mm. I was right. I wanted to ask you about this. I was reminded when you talked about go back to that boat. I want to make sure I'm following that correctly. I'm looking at a company, a security I'm involved or equity I'm involved in, and I'm asking myself
Mm.
if I went away on a boat for a while and then came back, would I feel confident that I held it? Is that correct? That was the thought experiment there. That's a way to look at to re-engineer your thinking, essentially.
Yeah, well, it's the idea that the boat thing establishes whether you're truly long term, whether or not you, at some level in you think that there's some risk, which would, because people sometimes buy things that are riskier than they should really do because they think it's going to go up and they might be right, but they're assuming that just because they're standing there watching it, they'll press sell quick, you know, I'm out, and because you're there, and so you feel comfortable. But if you're on a boat, you can't do that. And I'm not assuming that I've left instructions of other people or I have a stop loss, right? This is you're not meant to ask yourself that question. You're meant to ask yourself that you're just on a boat and it just has to sit there. And so that will tell you if that you perhaps have some underlying bias that is either it's skewed to a part of the return curve of this opportunity that is perhaps not actually what you really want. There are lots of things I look at where I'm like, yeah, I bet that probably goes up next week or the next few months. But is that, but it might still, but would I get on a boat? I'm like, no way, man. That could just suddenly dump at any moment. It's kind of like looking at Nvidia stock at the moment, right? A few months ago, I said it's probably going to go higher. These things usually get more stupid, but am I going to pay, 100 or 50 times or whatever the valuation is these days, so expensive, and get on a boat. No, the moment that any minute, that the market decides, like in 2022, that tech is suddenly a little expensive and there's a pullback, stuff like that can drop 50%. So, not to pick on that name, but regardless, yeah, that's kind of the idea of the boat analogy. It's putting yourself in the right psychological position for the type of investment that we're taking, which is that, we're thinking that we're acquiring the whole thing, and that
Mm.
we're taking it private. It's an LBO. And so these are all different questions that have very similar, put your mind in a similar mindset, should we say?
I'm reminded we had Christopher, I think Christopher Davis, his grand on the show. His grandfather, value investor, went for many years. Started with like a minimum. It was like it was either for some reason it was either 37,000 or 50,000. I don't have these two numbers in my head, but it was one of those two. So if you want to average it, or don't believe anything I'm saying, but there's a book on it. But he somewhere in his career he ended up representing the U.S. some form of political aspect, and he was away from the country for a while, and then he came back. But I was reminded of that story. He was invested in stocks the whole time. But yeah, in this story, he turned like 50,000 into 800 million or something like that. And a lot of it was just I was reminded of that story from that idea of being long on things that one believes in, that they have their research behind. I
Mhm.
think it's called Dynasty, something like that. Dynasty.
Sounds
It's about
like it if
this.
you do that. So,
Um, you know, Mark, I hope this is the first of many appearances on the Culture Matters podcast. I'm so excited to learn from you today, and I'm reminded of Seth Klarman at Baupost, Howard Marks, of course, Charlie Munger, Stanley Druckenmiller, some of the names that came up when I was preparing in my knowledge base, thinking who are some of contemporaries that I could relate to. Mark Magarian and the Magarian
well,
Fund on the
very,
Culture
very
Matters
kind.
podcast.
Yeah, I mean, these are guys obviously I look up to, and in terms of their investment record and all that, and you know, um, I'd like to think I'm heading in the right direction. So,
I'm excited to see what the next decade looks like, and continue to grow with you, my friend. Thank you again for coming on the Culture Matters podcast. I love
thank you, Jay.
the quote. It was uh, not to be right, but to win.
It's
Yeah,
more
yeah,
important
yeah.
to win than be right. That was your opening quote. That is
That's
it's one
you
of my
right there.
favorites, man.
I love that
It's
quote.
Yeah, a lot of people get confused by that quote because it's a very nuanced idea.
Yeah, can you unpack that? Actually, we probably should before
Yeah,
we
this might
end.
be a good thing to close on. So basically, a lot of people spend their time wanting to be right. They want to be right because it's their idea and because they said it first and because it's very intellectually gratifying to say that I told you so. And it's like saying that X stock is going to drop 10%. Okay, but then it goes up 5,000% and then drops 10% at the end. It's like, I told you. Like it's you were right in the end, but you didn't win. The win would have been to buy it, and then you're the winner. And
Yeah.
so yeah, I think it's more important to not let your ego get in the way of any of your decision making. If something's not working out, you don't have to be right about it. You're wrong. Okay, the win is to get out and get into something else, and I think that actually ties into there's a Buffett or Munger quote again, isn't it? That you don't have to make your money back the same way you lost it.
Mm.
That's important because a lot of people think they have to make their money back on the same stock, but they lost it, like it's a revenge trade or something like that. And I was a bit like that as well 20 years ago, for sure. Like we're all capable of
Today is the day I stopped doing this. I
yeah,
just,
like of
no,
making
this is helpful to me.
poor decisions. So yeah, it is more important to win to be right, and you know, putting yourself in a position to win is the goal. And don't let any other mental factors get in the way of that goal.
Mm. If people want to connect, follow, is there a way they can get in touch most easily to learn more
I'm on
about you?
I'm on LinkedIn. You can find me, or obviously contact Pine Valley, and everyone knows me there. So Pine Valley
Perfect.
Investments in New Jersey, in case there's any others around.
Mark, thank you again for doing this. If you're listening to this episode, please share this with a friend who has a desire to build their legacy through wealth, through learning, and wants to know the right path or a path that they can find their right path. Please share this with a friend. Leave us a view of the Culture Matters podcast and reach out to Mark, and we will see you next time. Thank you.
Thank you.